We'll get Colin, who heads our macro research team, to share his views on interest rates. And I think interest rates is kind of linked to something that Weiren shared just now, US high yield, a bond segment. So, there's an inverse relationship, a classic one between bond prices and interest rates. And I think maybe perhaps a lot of investors and even central banks are expecting interest rates to remain very low for a long period of time. But I think Colin will be sharing his views as to why there could be a reversal in interest rates in the next couple of years. So Colin, please.
Yeah, thanks, JP. I think that's a very valid question here. Certainly, I think investors around the world, even within US, even in the other DMs or even EMs, have benefited from this low interest rate environment. So a couple of asset classes that have seen these tremendous benefits are, of course, your meme stocks, your cryptocurrencies, as well as some of the growth stocks, or even your high yield markets, as well as your long bonds. So certainly, there's a lot of asset classes that benefit from that. And moving on, we definitely see a change or a shift in the macro regime, and that shift itself will definitely bring much more new opportunities, but more importantly, also a lot of different risks to the current asset classes that benefit from that. So with that said, and having set the kind of context, over the next couple of slides in this short presentation, I will go through what is the inflation outlook that as a house we see moving ahead, as well as the impacts on the different asset markets, and as well as the big questions of the change in the interest rate cycle over the next 2 years. So from this slide, you can see it summarized pretty well our view on the inflation outlook right now. So on the chart on the left-hand side, which shows you, which breaks into the component of your core PCE inflation. The components are your sensitive as well as the non-sensitive components. So what I do mean by sensitive is components or goods that are more sensitive to the COVID, to being affected by COVID. So when it comes to sensitivity, it is being measured by the quantity as well as the price change that has happened because of COVID. So if I were to draw your attention to just the last 2 months, you can see what a huge spike the sensitive component made up of the entire core PCE inflation. In fact, there's up to 70% of the core PCE inflation is being made up of your sensitive components. And yeah, moving ahead, we do see that this sensitive component will so slowly and start to decrease as your economies reopen and as your supply chain, your bottlenecks, all this slowly ease. Even though that will ease, but we do not think it is at a very rapid pace, because as economies reopen, we do envision a so-called staggered sequence where certain regions reopen, followed by the other few regions. So what we see now lately is the reopening of the US. So we are expecting a reopening of Europe, and as well as some of the other Asian markets and the remaining of the EM markets. So as that happens, we're likely to see some of this transitory factor clear up, as well as the base effect being wear off. But however, with that said, we do see some kind of sticky inflation in the data right now. So I would like to point out that one of the main culprits of where sticky inflation will likely come will be from the US housing markets. So as shown by the chart on the right, you can see the housing market price being plotted against the PCE component of housing-related inflation. So bear in mind, this housing-related inflation itself makes up of around 19 to 20% of your core PCE. And what is shown on the chart right now is that US houses, a median sales home price has risen about 25% on a year-on-year basis. And that itself leads the housing inflation by around 13 months. So with that said, we can definitely expect the inflation, that housing-related inflation has bottomed out and will likely increase over the next 1 year or so. And this tends to elevate your core PCE number, which essentially is the value that the Fed looks at when it comes to making interest rate decision. So with that said, let me bring you through the next slide shown over here, so you can see the different inflation scenarios that we have prepared. And investors do have to take note of these two scenarios. First, we have the central case, which we think is the one with a higher probability of happening. And then we also have a hawkish case, which even though there is a lower probability of it happening, but we do caution investors to take note of what are the kind of signals and signs of this hawkish case, as well as certain impacts, because both central case and hawkish case, there are wild and very different impacts on asset classes, and it serves investors well to be prepared for even both scenarios. So let me just quickly go through the central case right here. So for the central case, we do expect the core PC inflation to settle between around 2 to 3% over the next 2 years. So within the next 2 years, we'd like to see inflation to fluctuate around that kind of level. And in terms of the policy rates, we do expect somewhere around 3 rate hikes over the next 2 years. And when it comes to yields, we do expect over the next 2 years, yields will range somewhere around 2 to 3% as a result of the inflation backdrop. And you can see, as compared to what we've seen across history, which is shown on the chart on the left-hand side, over the past decade, post-GFC, we find that inflation averaged about 1.6%, and even before that, around 2%. So what we are expecting right now, going into the next couple of years, we are expecting inflation to average higher than what we see over the past 10 years. So we are likely to see a higher level of inflation over the past 10 years. And to support that view, and to really support that view is the fact that we do see some level of sticky inflation, like I mentioned earlier, housing inflation being relatively active over the next couple of years. And now I'm going to try to draw your attention to the hawkish case right here. So for the hawkish case, I think our projections are much higher than what we see in the central case, because in the hawkish case, for core PC inflation, we're expecting around 3 to 4%. And as a result of that, 4 to 5 rate hikes in the next 2 years. And because of that kind of inflation outlook, as well as the policy backdrop, we're likely to expect around 3 to 4% of a 10-year treasury yields over the next 2 years. So if you can see from this slide right here, as a result of the sort of inflation outlook, we are quite certain that we are likely to see a reversal in the interest rate cycle over the next 2 years. In fact, even as early as 2022, we are expecting a reversal of this interest rate cycle. So on the chart on the right-hand side shows both the different scenarios, the central case as well as the hawkish case. So to start off with the central case first, we are looking at about 1 rate hike at the end of next year and 2 rate hikes following that in 2023. So with that said, that brings the Fed fund range to about 75 to 100 basis points for the next 2 years. And for the hawkish case itself, we are expecting 2 rate hikes next year, around the end of next year, as well as 2 to 3 rate hikes in 2023. So essentially that will bring your Fed fund range to about 150 to 175 basis points. So as you can quite clearly see, this interest rate cycle is about to reverse. And when it comes to this reversal in the interest rate cycle, we think that the Fed looks at 3 main criteria when making their interest rate decision. So the first criteria, of course, is having a core PCE of 2% and above. And the second criteria is having a core PCE of 2% and above over a period of time. And the third criteria is maximum employment. So with our inflation backdrop or inflation outlook, we're expecting criteria 1 and criteria 2 to be met by next year, so by the end of next year. And for criteria 3, which is maximum employment, right now when we look at the payroll numbers, we are looking at around 6 million unemployment gap from here to the pre-COVID level. So with that said, when I look at how fast the employment is catching up right now, if we are to see 0.52 million gains every month in terms of payroll numbers, we're expecting to see maximum employment over the next 2 years. However, with the average rate that we are seeing on a year-to-date basis, we are looking at about 0.42 million gains per month. So even though there are certain gaps within the payroll rate, we do believe that this payroll can definitely increase when productivity level increases and when more of the workforce goes back to, or more of the population goes back into the workforce. So this is a gap that we think can be closed, and therefore we do see the possibility of a rate hike being somewhere around at the end of 2022. Yeah, and with this possible change in the interest rate environment next year, there is certain implications on the outlook of US Treasury yields. And more certainly, we are seeing that this low yield environment could possibly reverse itself. So like I mentioned earlier, for the central case itself, we're expecting the 10-year Treasury yield to range around 2 to 3% next year, and markets can definitely digest this kind of level of US Treasury yields. And for the hawkish case itself, we're expecting the US Treasury yields to range around 3 to 4%, and that brings us to levels seen just post GFC level between 2009 to 2012. So with that said, we do believe that the markets will kind of struggle at a bond yields of 3 to 4%. So there are some major implications of that. So of course, if you were to expect this hawkish scenario to play out, we do believe that the so-called damage on the asset classes will come from the rate of change of interest rate. So aside from just purely the value of US Treasury yield, is what's more important is the rate of change. So how fast the yields pick up when it comes to pricing in that kind of inflation backdrop. And with a 3 to 4% projection, we do expect yields to rise at a more rapid level, and it's quite similar to what we've seen over the past earlier in May as well as April, and with that kind of speed of rise in US Treasury yields. And with that said, there are two main implications on both the equity side as well as the fixed income side. So for the equity side, most definitely we think growth stocks will take a beating. And with that said, there are two separate categories of growth stocks that I would like to, where I typically see them. So I see them as one with the higher quality ones, one with a stronger balance sheet, one with less earnings volatility, and the other one which is more of having a weaker balance sheet and having a weaker earnings. So those with a weaker fundamentals, and those are the ones that will likely take a bigger hit if your inflation were to go, or if your US Treasury yield were to shoot up to that kind of level. And aside from that, if we look at the fixed income segment there, we think bonds will be hit relatively harder. So your long duration bonds will most definitely react the most when it comes to a rising yield, and that kind of price risk when it comes to rising yield will be definitely greater than your short duration bonds. So again, to summarize, we think that if interest rate were to rise to such, or your US Treasury yield were to rise to such levels, we'll likely see your growth stocks, especially the ones with weaker fundamentals, being hit the most, and for the fixed income side, the ones with the longer duration being hit the most. So over in the next slide, you can see that despite your fixed income segments being hit in an environment of higher US Treasury, we think that is not, investors should not dismiss fixed income, the asset class as a whole, because interest rate will eventually rise to such level, which makes fixed income relatively more attractive than your equity markets. So how do we discern that? We looked at the excess yield, which is the earnings yield, minus your risk-free rate, which is the bond yields. And with that, and at that kind of level, that tells us how much or how attractive your fixed income is relative to your equity markets. So if you take a look at the table right there, for our central case for the projection of 2% to 2.5% US Treasury yield, we are looking at the excess yield of above your historical average of 3.5%, and that being denoted by a positive z-score. And in that kind of scenario, the excess yield is telling us that equity markets are seemingly more attractive than fixed income, and it definitely justifies a neutral to at least a slightly overweight allocation to your equity markets. So in the bottom half, you see the hawkish case with the projection of 3 to 4% US Treasury yield. And you can see the excess yield that is being calculated then, and that shows us that the excess yield will be lower than historical average, and which that is being denoted by a negative z-score. And in that kind of scenario, we are looking at fixed income segment being less attractive than your equity segment, and essentially your excess yield itself justifies a neutral to overweight of fixed income versus equity markets. So essentially, to sum up what I've gone through over the past 10 minutes or so, what investors do have to take note is, moving ahead, we are likely to see a macro regime change where your interest rate is likely to get higher over the next few years, and with that change in your macro regime, we can do expect certain implication on asset markets, most certainly on your fixed income side as well as your equity side. And yeah, and that concludes the end of my presentation. So back to you, JP.
Yeah. Thank you very much, Colin. So I just have one question which is kind of related to your last point. So, you talked about this interest rate reversal from a very US point of view. So for investors in Singapore, how should we be, looking at this reversal in interest rate trends?
Right, I think with the reversal interest rate trend, the trigger is definitely at a higher inflation or higher inflation backdrop. So with that said, I think investors can benefit from a pro-inflation asset allocation. So I will go through some of the, from more of a geographical level down to the sectoral level, and how investors can execute this kind of a pro-inflationary backdrop. So on a geographical level, if we were to expect inflation to rise, in fact, we were to expect a change in interest rate environment, I think equity markets definitely will benefit more vis-a-vis fixed income markets until inflation or until interest rate rise to a certain extent, like I mentioned earlier. And within equity markets, we see there are certain regions that benefit most, and some of the regions are, in fact, Europe, in fact, Japan, as well as your emerging markets. And you have to look at the beta for all these markets versus your inflation break-even. Those markets itself have a higher beta. It means that whenever inflation goes up, we're likely to see a larger gain in those kind of markets. So all those markets definitely will benefit from the pro-inflation backdrop. So when it comes to on a sectorial basis, right? So there are a couple of sectors that will definitely benefit. So number one is definitely the commodity-related sectors. So we definitely see materials or even your industrial sectors benefiting from that. And aside from that, a more prominent one would definitely be energy sector. So a lot of people consider all these sectors as a hedge for commodities, which is empirically true as well. So some of these sectors, such as your industrial, your materials, or even your energy and financial sectors will definitely benefit from the kind of pro-inflation environment. So with that said, maybe I would conclude by talking a little bit on the fixed income markets, how to position in that kind of environment. So within the fixed income markets, like I mentioned earlier, definitely the longer duration ones we get hit more with a change in interest rate, and which is empirically true as well. So investors can definitely lean into the shorter duration ones, or even the intermediate duration ones at the belly of the curve, and those are the ones that investors should lean towards within the fixed income markets. Yeah.
Yeah, thank you very much, Colin.